So first of all, let me introduce our two guests that are making it possible. Eitan Katz, the CEO of the Kima network, and James Davies, the CEO of the CVEX. My name is Vitaly, and I'm product owner for the CVEX. So hopefully I will steer this conversation in the right direction today. And we'll get some insights on how CVEX and Kima makes this possible. So Eitan, could you please confirm that you can hear us and everything's okay?
I'm here. I can hear you perfectly.
Yeah, me too.
Awesome. So, James, Eitan, if you can address what is actually liquidity fragmentation and maybe to say liquidity crisis in DeFi right now, and just to give us an overview, why is this important and how this will make life for users better.
Sure. Well, Eitan, why don't you take first go and I'll talk about this more broadly.
Yeah, sure, definitely. So, first of all, happy to be here and thanks for hosting us today. So when we talk about fragmentation, I always like to give an example from the real life. Imagine that you're on a road trip and you need gas in your car, and every gas station only accepts a specific brand of your card. If you don't have the card that they accept, you cannot use it. So then you have to go and find an ATM, withdraw cash, and then potentially convert it to another card to use that card in that gas station. It sounds unrealistic because in our real life we got used to removing the fragmentation among the payment rails and the payment utilities, but in crypto and DeFi we still have that kind of a problem. Liquidity, which is a fancy term for money, is stuck in separate blockchains due to technical and implementation decisions. But if we want to really move from one silo to the other, that requires wasting time and paying extra fees. So that's obviously slow, it's expensive, it's inefficient, and sometimes it even requires additional intermediaries. Instead of that, if we could have some way or ways for a seamless global system, we could have those islands of liquidity being converged, and the money in those silos can flow seamlessly between those islands. That would make everything faster, cheaper, more efficient, and easier for the users as well. So that's how I see the challenge of fragmentation. And due to this challenge, this is one of the reasons that we, as an industry, we find it so difficult to bring additional people, additional money into the system. The user experience becomes problematic, and this is something we really need to solve in order to make DeFi scalable, make liquidity unified and accessible across all those silos.
That's an excellent and laudable set of goals to try to make it work, and I can see it's very difficult to get there. So I think on the Crypto Valley side, we're really focused on trying to look at a couple of narrow aspects of where fragmentation has occurred, and that's mostly in the collateral management area. And that has a knock-on effect on the liquidity. But if we step back and sort of look at this more broadly, fragmentation is something that happens across a lot of financial markets. In some areas, it's particularly widespread. So in the trading of stocks, there were a set of rules that came in about 2006, 7, 8, which enabled this explosion in the number of venues. And you see people like Bats and CVEX and Arca and all of these guys came out with stock offerings and stock platforms, the ECN networks, which enabled people to have new innovative front ends, new ways of trading. But when we started to look at them after a few years, like 3 or 4 years, which maybe is around the same time since we've had these new mechanics in the DeFi space, we discovered that people were getting worse trading prices than they had on the historical things. Now, we also liked some of these innovations. We didn't want to leave without them. And it ended up that the regulators had to step in and said that anyone presenting something to the retail people had to guarantee best execution. If you were an institutional player, you had to look after yourself. But if you were a retail client, you deserved best execution. And it was up to the broker or the person facing you to assure you that they had it. So we saw this then proliferation of platforms that would do consolidation and bring those prices together. And then networks really competed for how they were enabling market makers to provide liquidity to them and the different mechanics around it. And we stopped seeing people looking individually at different networks and started seeing them looking at brokers that focused on consolidation. And that's what we've seen in some of the DeFi space. In the derivative space, in traditional finance, this is a non-issue because futures have so much value to be able to bring collateral together. You can do statistical arbitrage, you can do calendar spreads, you can do so much more trading for the amount of money you lock up. So you should be locking something like 7 or 8% of the collateral to the volume that you turn over in traditional markets. In crypto, we see the reverse. So we see people looking at this. Like I saw GMX the other day has 350 million in TVL, but only 128 million in open interest. It's probably 80 million of that in a Bitcoin pool somewhere for swaps. But really, it's upside down compared to TradFi. You should be looking to see the volume at something like a 10x multiple of the amount of assets that's locked up in that protocol. And that would show that we're getting the same sort of efficiency. So our view coming into this is Crypto Valley is to try to label this base layer. And yes, we want people to come and trade through our platform and through our mechanics, but we'd also encourage other groups and other exchanges to come to connect to us and use that same efficiency platform to enable their own people. We want to enable all of these different ways of trading to come back and bring it back to the center. And then we get collateral efficiency. We don't get fragmentation of collateral, and we can have lots of different mechanics for how we go about price discovery, but we have real efficiency at the back end piece. And that's the derivatives equivalent to the payment pieces and the movement that we've been just talking about with Kima and the laudable set of goals in that space. So our view is collateral efficiency enables a lot of the rest of the innovation, and that's where we're focused.
Makes sense, James. Before we address I think I have all the questions basically of how Kima helps to solve this problem in DeFi as well. But you mentioned, James, the way how to measure this efficiency and the opposite of the fragmentation for the derivatives and for the clearing protocols. But is there any other metrics that allows to measure this for the whole ecosystem? How we can see the scale of the problem currently of how it's bad and how fragmented it is.
So, we definitely can measure the impact of fragmentation. So there are some metrics like high slippage and poor execution. We see low liquidity utilization rates. For us, this is a major metric because it's not just about locking TVL somewhere. It's about making the money work and move in order to work for the user. So low liquidity utilization means that the capital sits idle. And one of the reasons that it sits idle is fragmentation, because it is very difficult and expensive to move to other ecosystem that could potentially provide better yield for the money. So instead of deploying it efficiently, it sits idle. We also see the need for multiple liquidity pools, isolated pools, which create which actually spreads the capital too thin. So nobody wins from these effects on capital, and from the get-go of Kima, we always looked at utilization. So if money gets deployed efficiently, obviously it is more effective. And this is why we always look at the actual utilization, which means if you look at the ratio between the actual TVL and volume, that gives you a good hint, a good indication for how effective is this ecosystem. Because if the volume is high and the TVL is low, that means that the money gets utilized very, very efficiently. So I know that TVL is something that we tend to measure in crypto, and we look at this to DeFi Llama, but this only tells part of the story, especially when we want to look at efficiency and fragmentation. So we optimize from the get-go, we optimize Kima to hold the minimal amount of money to serve the needed volume. So we don't want money to just sit idle. We want the money that we need, and just the money that we need. So it serves the requirements for the velocity and the transfers, and not just to have money sitting still in liquidity pools.
Could not agree more. That's so much of the view where it was very simple when we had only a handful of assets to use TVL as a proxy for utilization that don't apply. Now we have more assets and more trading capabilities, and actually it's become an anti-metric. If something's got a very high TVL, it may have a low volume, and that shows how inefficient it is. And we have maximized the metric that we've all accepted for a short period of time, and I think that will need to go away. Our locked capital, our locked collateral, as we prefer to look at it, versus volume is just outstanding compared to so much of the marketplace. But this is something that affects crypto as a whole. We should be expecting to see, like on the minimum side compared to traditional markets, something like 5 times the spots turning over in derivatives markets. And we see about 1.5 times, which means it should be turning over about $1 trillion. And in fees, it's turning over 4 trillion in volume, but it should be turning over about $1 trillion in fees across all of the derivatives markets. It's turning over 220 billion. And that's because that capital can't be put to work in the right way. So it's a step change. The best products that are out there that don't have portfolio risk, which is everybody apart from us and a little bit of Deribit, aren't able to produce this effect in the derivative spaces. And then you see that same sort of willingness to have that inefficiency across all of these different categories within the DeFi space. So it's really good to see someone coming at it with the same mindset as they're looking at their part of that ecosystem.
Yeah, it's really interesting to think of Kima like as a driver for the volume to the protocols, because like there are a bunch of DeFi protocols, like for example in Swap with 3 like protocols. There is like AVA that allows you to borrow the positions, and I'm curious of like what Kima has to offer like for the DeFi sector as well, because like it's obvious that Kima makes accessible like the money flows through different chains and basically consolidating like the tokens and like ERC20 liquidity to say, but like there are a lot of other DeFi mediums, and I'm curious like if Kima has anything to offer to that field, and if like there is something to expect.
To offer to the trading, you mean?
So yeah, as far as I understand, like what Kima does is basically like cross-chain liquidity, like one chain to another, right? And like I think this is applicable a lot to ERC20 tokens, right? Like basically to anything like that is tokenized. And like there are a lot of other mediums, like for example, there is Uniswap with 3 like positions, like there are positions on like our protocol, and like is there anything that those types of protocol, and maybe like including ours, can benefit from Kima network and will join these liquidity pools with these entities?
Yeah, definitely. So, the first fragmentation impacts anything, right? Your area is derivatives and trading, so there, anything that is related to um, margin trading and clearance becomes less efficient. Trading that can create arbitrage and inefficiencies related to that, and in lending, so fragmentation causes split capital across multiple chains. So all these inefficiencies um, are related to the complexity of moving funds from one chain to the other, and even within the same chain from one asset to the other, even if they're based on the same underlying asset, like in the case of stablecoin. So if we have PYUSD from PayPal and USDC from Circle and USDT from Tether and so on and so forth, and I'm speaking with so many stablecoin issuers, the underlying asset is the same, but then utilizing it becomes a problem because it's not the same asset, even if the value is identical or should be identical. So by solving this problem, we create an abstraction layer where it doesn't matter if you're holding USDC and your counterparty needs USDT for whatever the transaction is, if it's an e-commerce transaction or a swap transaction or whatever it is, the difference between the two assets becomes irrelevant, because now there is a universal rail that can move those assets seamlessly with no slippage and no impact on the price, with very, very low fees, high level of security, and instant settlement. So now, instead of having those fragmented assets, it becomes irrelevant, and all the assets can move freely across chains, across issuers, and that is now all the impact or the problems that I mentioned earlier. Many of them go away because now those assets can move freely. So our vision is really to, it's not just unifying in the sense, unifying is, for me, is a means to an end. It's something that we do, or even could be a side effect. The vision is really to remove the sense of fragmentation. So you don't care if your counterparty is expecting to get USDC or Circle from Circle on Ethereum, and you're holding US dollars in a bank account. That shouldn't, nobody should care about it, as long as there's an efficient rail that can abstract these differences. And basically, this is really the vision, and from this, everything else is derived.
Sounds great. Thanks for the answer. Getting back to the next topic. So, James, I know you have like really rich background in TradFi, like in institutional finances, and my guess is that like fragmented liquidity is what maybe scares away like some institutions from entering the DeFi space. And I'm curious, like what is the main things that maybe we need to provide to the DeFi, so like it makes the DeFi more accessible to institutions and larger market participants.
So it's interesting because it's a non-problem in TradFi, and on the derivative side, in the swaps, in the futures, in the options spaces, in everything that looks like a scaled product for trading, whether it's real-world assets, say gases and commodities, or treasuries or stock indices, we don't have a fragmentation problem in derivatives. But it's because there's so much value in the clearing product set. You get so much capital efficiency that the ability for people to launch competitive pools and drag liquidity away from those cleared, efficient pools has been zero. So it's an open market, but the level of innovation that you need with new tools for trading, new automated ways, different ways of committing liquidity, and lower costs for market makers in sort of committing and transacting liquidity is blown away by the efficiency of a clearing solution. When you start to get into it, it becomes incredibly sticky. But that's what's prevented real world assets coming in. So we had this conversation with one of the big Middle Eastern gas companies, and they are looking to digitize a lot of their gas flow. They would like to build, it's all derivatives. I mean, the gas market is turning over maybe 15 times as much derivatives in notional value as it does in actual spot delivery. So everything trades as derivatives multiple times and then is spot. They want to bring that on chain. There's no point bringing the spot market on chain. It's like treasuries. There's no point bringing treasuries on chain because it's all traded as derivatives and they turn over a few times. That's sort of what I did for 10 years. But in that gas market, they were thinking, okay, well, they want to get away from a US-centric world. They wanted to no longer be dependent on NYMEX or somewhere like that to trade. They felt they wanted to have some independence to build their own marketplaces. And given everything that's gone on in the world, they wanted to go digital. They wanted to have a digital way of doing those real-world transactions. So they spoke to a whole collection of different DeFi perp dexes. They basically spoke to everybody that's got a decent number on a perp dex. And the lesson that they learned when they came back was that they would have to ask all of their partners to triple the amount of capital that they had to be able to support the trading that they wanted to do. And that's never going to happen. It means that their trading will not move away from the US-centric traditional finance. So they then engaged a few people in the market, said they need a clearing solution. We need portfolio risk at the center of this. So that's really where we see the lessons, is that some of the easy stuff where there's lots of innovation that we can do straightforwardly about AMMs, about lending pools, about transactions, they're not where the efficiency is in TradFi. The efficiency is in the back office. It's all in that settlement routines that are invisible to the world because it's not sexy. But that's why it's so sticky. That's why it's been so hard to move all of this across. And derivatives is what? Something like 1,000 times bigger than the payments network. So the amount of money that goes through CME in a day is about the same that goes through Visa in a year. You know, it's not Swift. I think it takes 3 days for CME to get to the same level of volume that Swift does in a year. So this is where the movement of real world assets are. But we're not going to get people going for them until they can start to get over all of these barriers they've got. And however we look at that lens, we've built a fragmented market. And we need to bring it together. We need to bring it together by better accessibility, smoother transitions to move money around, and a better set of solutions for how we calculate and lock up capital. And we're one part of that, and people like Kima are another part. And then there will be a whole bunch of people in the sort of brokerage, order routing space trying to optimize these things that we will see emerge. And then probably a whole prime brokerage network and a rehypothecation network. And there's lots of components of TradFi still to come. We're some of the early guys. But we do it right, and people like us and Kima will be the names that you remember in 15 years' time, in the way that I don't talk about Netscape, I talk about Google. Netscape were around for a long time in the early 90s when I was using these platforms, but we don't talk about them anymore. We talk about some entities that emerged around the turn of the century. It's going to be the entities that come through the second generation that last out the next 20, 30 years, because we'll have better product market fit and we won't have all of this incumbency to deal with.
That's great. And I think the Kima is the part that also can like help to onboard like those institutions, because I know that there are on-ramp fiat services, right, that Kima can support. So maybe Eitan, you can elaborate on that piece as well, like for some groups and fields. Okay.
Yes, indeed, and this is I think part of what makes Kima stand out in terms of its capabilities. So going back to the vision from day one was to solve not just the problem of doing cross-chain, but rather we saw the evolving digital asset space, and stablecoins are part of it. CBDCs could be another part of it. Wholesale, retail CBDCs, which well, I don't know if I'm ruining any romantic ideas for people, but I don't know if anyone thinks today that DeFi is going to replace TradFi. These two systems need to live side by side. So if they need to live side by side, they must also interact and transact. We cannot assume that it will be one or the other. This is really the vision, and now the question is technically how this can be achieved. Before Kima and without Kima, the only way to reconcile these two completely different architectures and technologies is to put an intermediary, someone in the middle that has integrations with both ends, which cannot be integrated by definition, and they become the intermediary, the exchange, the entity that does the swap. Now, we built DeFi because we wanted to get rid of these intermediaries. Now we're bringing them back to facilitate those transactions, and that's exactly what Kima is trying to do differently. We use the attributes of a blockchain. Kima is a blockchain. It's a blockchain. It's a protocol. It's a network of liquidity, and it's a network of banking service providers. So with all these components, we can create this magic of having an on-chain transaction that settles a transaction that includes the fiat and is connected to a bank account without the intermediaries. The validators of the Kima blockchain, they get connected directly to a bank account, and now it is possible to validate transaction on a bank account and sign cryptographically transactions in a bank account for withdrawing funds. And that's really the secret sauce of Kima. We do that in a secure manner with a completely novel, different architecture. So once we connect the two worlds and this connection is secure, is protected, can be even secured by the institutions, then they can feel more comfortable joining and integrating with DeFi. So one of the banks that we're speaking with, they implemented a very simple solution just for providing a pricing oracle. The problem is that this pricing oracle is relying on a set of entities that this bank has no control over. They don't know who they are. That could even be some kind of, I don't know, a network of machines in North Korea. Nobody knows who those relayers may be, and they don't feel comfortable with that. So they need a solution that they need this box within their premises, within their firewall that they can control, and they know that the data that is being sent out is accurate and reliable. And that is the type of integrations that the Kima blockchain is able to do. And that's what makes institutions feel comfortable in applying or adding their services and interconnecting them with DeFi, because there are some things that they will never settle for. And as this executive that I spoke with, he told me, our customers, they come to us because we're boring. They're not looking for excitement. They're not looking for decentralization. They want efficiency. They want access to these new asset classes. They want 24/7. They want instant settlements. That they want, but they're not here for excitements and price fluctuations and hacks. So, yeah. So to summarize, we make this bridge in a secure manner, and that's what makes institutions comfortable.
Yeah. I'm following with a short story that sort of tries to echo some of the importance of DAO for some of these people in something that they will use in the long term. About a year ago, I was having coffee with the treasurer of Credit Suisse, maybe just over a year ago, before they popped. And he was looking for ways to reduce their collateral. And they have massive amounts on the balance sheet, but it's locked up because of the assets that they were trading, and they were trying to find new and unique ways to do it. And one of his goals was, if he could get instant settlement rather than 2-day settlement on their FX swaps collateral, then he could drop about 600 million's worth of stuff off the balance sheet just in the first three currencies, probably more like 3 or 4 billion as they would build that up. And that's just 2 days worth of their transaction flows being compressed against each other. And the suggestion had been made to them that they try to arrange to do this in stablecoins with their counterparties. But as they went through the stablecoin market, they couldn't find anything that was compliant with their requirements that wouldn't end up adding more risk and adding more Basel Tier 1 capital to what they needed to do rather than reducing it. It's about the structure of those entities. So they were looking quite heavily into building their own with a few different counterparties to do that offshore. So they're keenly interested. The TradFi groups really want to see some of the blockchain technology. And sometimes it's when they're under pressure like that because it can allow them to do some of the instant settlement pieces. But if the trappings around that, if the structure of those instruments, if the structures of the stable coins or the structures of the settlement processes and the calculations don't meet their requirements as well, that they don't tick every single box perfectly, they can't use it. We don't have the opportunity of cutting some of those corners, but actually, I think most of the stuff that we look at here where we really want to make improvements compared to what's out in the marketplace doesn't mean that we have to cut any corners. But if we get these things right, then they are part of that story. They will be adopting and moving those parts. And then we have a once-in-a-generation opportunity to do it in a way where it's open and accessible, where other people can come in the same way, where retail is not sat with some limited access, where they're being told, here, use perps because they're better, when they really obviously aren't, where they cost more. They have higher collateral costs. They have funding fees. They're just a poorer product that's there because the centralized exchanges couldn't get regulated in the right way at the right time in 2017, that they pass off as something that's better because they can't do the other aspect. But as we move into this, we can create this open field and it will be everybody in one space. So it won't be us versus them. It'll be bringing everyone into the same space, but making it accessible, making it transparent, making it something that we can see that the behaviors in there are appropriate and no one is being defrauded. So I think echoing that need for these things to happen at the same time, and that there is an appetite amongst those guys and they want it to be dull. They want it to look like the things they have, but there are lots of opportunities for us to do that in a way that has a profound effect on how we all address finance and financial markets, which is a large part of our lives.
Yeah, it's really great to hear that Kima also considers this trustless approach, because I remember when we were considering how to proceed with some cross-chain deposits, we saw a bunch of black boxes that are operating on the market, both centralized, decentralized, and all of them are mostly trusted, and you really trust someone with your funds, and that's when we've chosen, I think, the best what we could is the cross-chain transfer protocol from Circle, and I think this is really good case study from our side, how we have a lot multiple deposits from multiple chains and basically reach that capital. So maybe James, if you can elaborate on this approach as well, and how this works for us. And basically, we can also find some synergies with Kima approach.
I actually, to be honest, I know you're the host in this, Vitaly, but you are the expert here. And I think we should have more than one voice. So feel free to just explain that aspect of what we do.
Sure. Yeah. So basically, for our exchange, we have a deposit mechanics which utilizes the cross-chain transfer protocol. that Circle operates, and like even though like it's trusted like in a way that Circle is ultimately the one who burns and mints tokens like on one chain and another, right? But it's still like if you know trust Circle with the UTC, then obviously we trust Circle with their bridge as well, because like they're the one who can mint the token and can burn it and can cover our losses like if anything goes wrong. And what the Kima offering here is to make it completely trustless. So I'm wondering, like for us as a protocol, or for us as an exchange, like is there any practical way to integrate right now and basically to start leveraging Kima potential?
Yeah. Absolutely. So CCTP from Circle is definitely um, great solution. As you said, Vitaly, the problem is that it applies to Circle, and Circle is one player, one entity. It's a very meaningful one, but it's not the only one, not even the largest one. And there's a lot going on in other silos of stablecoins, and we're speaking with several stablecoin issuers, and everyone's on. It's on everyone's mind, except for the largest ones that have the network effect, how they can become compatible with the rest of the market. And I think we'll start seeing different types of stable coins with different compliance schemes. So we will see, we'll have the general stable coins, but we'll see also more specific stable coins for specific usages. So it's possible to rely on CCTP, but we believe that that's not a scalable solution, because at the end of the day, you cannot ignore Tether if you're outside of Europe. You cannot ignore the other MiCA compliant stablecoins in Europe. You cannot ignore PayPal, and you cannot ignore other providers, the banks that are starting to issue their own stablecoins or tokenized deposits. And so the need is for a more generic solution, not to mention the need to tap into fiat liquidity. And we see Circle, obviously they make it very efficient, they make it free of charge, but there is only small demand. You need to work exclusively with Circle, and I think this is maybe good for some use cases, but generally speaking, there's a need for this generic solution, and we believe that bridges per se, they do not, although being the most common method for trying to interoperate between those systems, they introduce a very major security risks. We see hacks, we see rug pulls related to bridges, and there's actually no other universal liquidity layer and then interoperability layer out there that can handle with one API, with a single integration, all types of asset classes except for Kima, and that's really the unique value proposition that we offer.
So maybe it's a good moment to say why we only support USDC as collateral, right? Quite apart from the simplicity of trying to work these things out against each other at the moment. It's talking to the institutional players who are trying to reduce their balance sheet aspect. A lot of these people are regulated, and they're the people we want to come and bring the flow into us. And for them, they have to make a balance sheet allocation for the asset based on the risks asset. And the more of a mix of things it has underneath it, the less compliant it is, the higher the allocation they have to make. And in general, that allocation reduces the effective yield, because you can look at how much yield you can make using a particular stablecoin for different activities. And then you have to compare that not against the amount of the stablecoin you have, but against the allocation you have to lock on your balance sheet. And this is one of the reasons why we talk about high yielding assets in DeFi and we say, oh, well, this asset's yielding 10%. And therefore it should be attractive to TradFi guys to come in because treasuries are only yielding 2.4% or 4% at the right part of the curve. And therefore you should get 6% more. But to lock up asset to trade that, they have to do a balance sheet allocation, which doubles the amount of risk that they have. It reduces the yields back below. So most of the yield in our instruments is actually a function of the risk that's in them, because institutions are going to come in and trade them if they've got a big yield. They will price that risk appropriately and they will trade and balance those things against each other. And that's when we look at stable coins. For derivatives trading, we want to get the really big monies come and trade alongside everybody else because it's massive. It's a 1.4 quadrillion marketplace. To do that, we have to have stable coins that meet the requirements. Actually, none of them may meet it right now, but Circle's the closest that we've seen so far. By bringing other assets in, we don't enable those people to come through. And so one of the interesting aspects when I look at things like Mika, and like one of my neighbors is one of the people who drafted some of the beginning of Mika and PSD2 in the European Parliament, and talking closely about what they were going in, it's all focused on payments platforms. And the accounting and the appropriate usage in payments platforms has a much lower threshold than it does for derivatives trading. So what we're hoping to see markets that will sit alongside us, people like Morpho, where they would be able to do lending and movement in and out of our assets, and then groups like him to move it all around really smoothly. So the end asset that's sat in the clearing protocol means that you can guarantee those trades, but you can smoothly move in and out of the other assets that you would like to push up for collateral through efficient mechanics out there. And you don't have to worry about what the relative credit worthiness of something is. Let the institutional side work at that, and let all the DeFi projects come together, build together, and solve those problems around that side. And we will just focus on the core of driving that really massive capital efficiency that sits in derivatives markets. But it's interesting. Mika has this. If it's Mika compliant, then it should be good enough, and doesn't even come close on the derivative side. It's not Basel Tier 1 capital compliant. Mika's good for payments platforms, not good for derivatives platforms. So it's just an interesting difference in the position. Eitan, if you want to come back in on that, more than welcome.
No. I thanks for clarifying it. Yeah, I'm no expert in derivatives trading, and indeed our main focus is on payments. But I thank you for that. I learned a lot right now about the intricacies behind derivatives trading.
Cool. I'll let you, Vitaly, carry on.
Yeah, thank you, James. So before I think we go to questions from the audience, like I just had a last question that basically interested me a lot about the POCs with the banks that Kima have arranged or like in a process with. So like this is really interesting model, like as I mentioned, like a trusted way to trustless way basically to deposit like from your bank account like to the Kima network, so you can have like this unified liquidity. I'm curious like of like whether there's any success with that, and when do we expect to have like something practical to interact with and as to leverage for the deposits like on the protocols or just for the bridges?
Yeah, so we did the very interesting pilots with the central banks, and we are working with some commercial banks as well. On the central banks side, obviously, everyone is experimenting now with the CBDCs. That's whether we like it or not. I'm not getting into that. It's a fact that central banks are considering some form of digital currency. Obviously, there are many issues of privacy and control, but putting all those aside, there is also a big promise that if the central bank is issuing digital currency, that creates, I think, a massive opportunity for fintechs, because now not everything has to go through banks, and I think it will open a lot of innovative use cases, and that's why we're interested in those pilots. So we did one pilot where we showcased how Kima can function as a decentralized escrow for an atomic swap, peer-to-peer. One party is holding a digitized or a tokenized stock. The other party is holding the means of payment, the CBDC, and the two parties now want to exchange. The only way to do it today is having some kind of an escrow. The two parties need to deposit, and then the swap takes place. So what we showcased is how Kima can function as this decentralized escrow. No need for a third party. The two parties, they approve the transaction, they agree on the terms, and then they actually deposit the assets into a vault or an account that is controlled by the blockchain. There's no single entity that now is the custodian of these assets, and only when the two parties made a deposit, the swap takes place, and all of that happens in one single transaction that can be reverted if one of the terms is not fulfilled. So that's one pilot that we showcased. Obviously, it has many. This is DVP, delivery versus payment. It has many other use cases. So that was a very interesting case to show. We're currently involved in another pilot with the central bank. Unfortunately, they did not announce it yet, so I cannot relate to the name of the central bank, but it's one that everyone knows. And there we showcase a use case of green bonds, tokenized bonds, where the payment to the contractor is done through milestones that get verified by off-chain, and then money gets emitted to the contractor based on their success. So it's a pay for success kind of use case with
project finance.
Sorry?
For project finance, when like people are building bridges and shit.
Yes,
stuff.
yes, exactly. So the finance, these projects are being financed through bonds, and the government gets involved and pays the yield. But the whole thing is that now this process is completely automated. So from the issuance and the money, the primary offering, and then the emission of the funds to the contractor. So again, we're doing it in a unique way. We did without smart contracts due to potential vulnerabilities. We think that smart contracts are a great technology, but there's a lot of risk if they hold funds. They become honeypots for hackers. So yeah, that's the other pilot, and we see these pilots as just ways to learn, to mature the system that we have, and learn from market requirements. So yeah, these are just two examples, and obviously another big use case that we are now exploring with banks is cross-border transactions, where Kima functions as a network of liquidity in multiple places. So the settlement is instant. Money flows locally into and out of the Kima liquidity pools, and obviously the fees for these transactions are extremely low compared to what happens today. So instant settlement instead of T+2, T+4, and extremely low fees.
Yeah, there's lots of good stuff in that.
Future.
There's loads of good stuff. That's That's really good to hear. There's massive problems across trying to do that. Just one more. Have you looked at warehouse receipt settlement?
Nope. No, we didn't have a chance to look into it.
That might be interesting, because a lot of the real world asset stuff that we get asked about that people would like to trade are physical commodities settled out of warehouses. And whilst we can cash settle against indexes using our platform, and people can build their own platforms on top of us to do that, at the end of it all, to really get to a place where it's going to be properly effective, you need to be able to enable tracking of physical delivery. So the warehouse receipt stuff, the sort of thing that is done by Shield from London Metals Exchange, but on a broader scale, more globally, there's lots of different warehouse receipts issues where you can settle a contract by doing the transfer on a warehouse receipts platform. And there are lots of different warehouse receipts platforms you want to guarantee that those are traded. And that's where a lot of sort of more regular commodities market works. I can see the workflow that you were talking about in the project finance world. I'm intimately familiar with, because it's what my wife did for years, but I can see exactly where you're coming from and how that works, but it's also nice and commoditized. It's not super high frequency, but it has a lot of value, so people can invest it in the right way. As you come down the curve of value per trade to higher frequency stuff that's still not day to day, that warehouse receipt space is something that fits very neatly alongside what you're saying, but there's a lot of people out there looking for those solutions at the moment.
Interesting. So let's follow up on that. Interesting.
Absolutely.
Thank you. I know we're limited on time, so let's get some time for the questions from the audience. Is it ready? So please raise your hand if you want to ask anything from James or Eitan. Okay, in the meantime, maybe anything to add from you, James?
Not a lot. I've come in Eitan with this. I think these solutions are us seeing this third generation of products built. So we have this first generation that came out where the exchanges were there in the spot space. We had the first generation of DeFi products where we're seeing some really basic protocol stuff, some of the AMN building for the first time, some of the lending protocols. And now what we're doing is we're trying to go, okay, we've proven the core of this. How do we make sure that this third generation of projects that's coming out in that DeFi space is really solving these real world problems in a scalable manner? And I think that's what both of us are focused.
Yeah, I totally agree. I think, James, you really made it very clear. And I think that it's about the next generation. It's about scalability. It's about interconnecting with the traditional finance and enable the flow of funds between these two disparate ecosystems. And it's not a matter of if or when. We know already that institutions they apply, they play with these concepts, they test them and explore them. So I think this really matures this entire ecosystem and makes these technologies really needed right now. It's not a matter of years to come. It's happening now. So again, I thank you for the opportunity to explain what we do.
Excellent. Look forward to our offline chats.
Yeah, was happy to learn. Great. Okay, so if there are any questions from Zodia, please go ahead, or let's wrap it up. And thanks to our guests, James and Eitan. Great pleasure to you.
Thank you. Thanks for hosting the first one of these that we've done like this. I'm sure it'll get watched lots as people build through the others. Thank you, Vitaly. Thank you, Kima. Thank you, Eitan from Kima.
Thank you,
everyone.
Thank you.
Good.